Okay, just a quick video on sale or return. So sale or return linked to the accounting concept of realization, and so is a concept that comes up quite often in exam questions, and so it's something you need to be aware of because sale or return can just be part of one of the adjustments in an income statement, SFP question, or in a number of areas. So anyway, so the first example here, so I put the notes around it so you can see where the calculations come in. So a company has sent goods to a customer on a sale or return basis at the end of the year. The customer still holds these goods, and the business had mistakenly included the full shipment in its financial statements. So they still hold £3,600 worth of goods. Now, because of realization, the idea that legal title of the sale, so the legal title of the goods, should be passed before it could be recorded as a sale. So because of that, we're going to have to reduce revenue by 3,600 because we've overstated revenue. We're also going to have to reduce trade receivables by 3,600 because there's no legal claim. They don't owe us any money because we've told them that they only pay us for items if they actually sell them. The other important part of sale and return is the seller still owns that inventory. So they've still got the risk and reward of ownership because if the inventory doesn't sell, they're the ones who lose out, not their customer. But you've got to be careful because inventory has to be valued at lower of cost and net realizable value. So that 25% markup needs to be used to calculate the cost value. And so 3,600 divided by 1.25, because the markup is the revenue includes the profit. So cost is 100%. So you can go 3,600 divided by 125 times 100 if you prefer. But either way, inventory would need to go up by 2,880 because we've still got those goods. So the net impact, if you look in the top left, so profit would fall by £720 because we've got the reduction in revenue, and then we've got the increase in inventory partially compensates for that because closing inventory gets deducted from cost of sales, so therefore increases profit. So overall, the fact that we've removed that from our records means that profit will fall by £720, but also assets, because we've got one asset, i.e. trade receivables, is going down and inventory going up. So we've got a reduction in assets with the same value, which has to be the same value because it's the accounting equation. That's how our statements balance. The second one, what about if we purchase on a sale and return basis? So we didn't record the sale and return as a purchase. We didn't put it in trade payables. So most of the way we're correct. However, we've accidentally counted items that were on a sale and return basis and included them in our inventory valuation. So that being said, we have to remove those clearly. So we're going to remove the value of those items. 5,400, that's the amount we were invoiced, so that's the amount that we'll reduce it by. So we'll reduce our closing inventory by 5,400. That will reduce our profit by 5,400 because cost of sales will go up. It will also reduce our assets because our inventory valuation would reduce by 5,400 as well. So sale and return, if you're looking at it, there's positive aspects and there's negative aspects, but you've got to make sure you're linking it to the realization concept. But it comes up a lot, so make sure you know how to do it. Okay, cheers.